at the macro or bigger level, there's really two investing extremes. Buy and hold on one end and active trading on the other. And you can have a little bit of mixture between the two, but in the end, you're looking at buy and hold versus active trading. Because with both of those ends of the spectrum, so to speak, you can then invest in different stocks from different market caps, or use different strategies such as investing in growth stocks or value stocks, or using something more exotic like dogs of the Dow or something of that nature that we're going to learn about, or just tracking an index or buying individual stocks or mutual funds. All these things are part of this. So those are the individual strategies. We'll look at the actual tactics. But in the end, you got the two extremes. Do I buy these vehicles? Do I buy these individual stocks or mutual funds? Or do I implement this strategy around buying low, undervalued stocks as a value investor? Or am I buying growth stocks or whatever it might be? But once I buy them, do I hold them for a long period of time, which is buy and hold? Or do I buy and maybe be more active in trading and switching those out? And that's what we're going to look at here in this lesson, is looking at buy and hold versus active trading. And then the future lessons, we're going to then see how we can then implement different strategies and tactics, but we still might, as an investor, be more of one side or the other, maybe a mixture, but usually you're one side or the other for the most part. As far as a philosophy that you have from investing in these investing streams. So let's look at buy and hold and active trading. So first off, buy and hold. What are the advantages of buying and holding, and what do we mean by buy and hold? Well, first off, buy and hold means you're buying something and holding it for long periods of time, right? You might be holding a stock for 20 years. You might be holding it for a couple of years. It's not something that you're turning over in less than a year typically. Something you're going to hold for at least a year, maybe 2, 3. And the idea is you really want to hold it maybe for 4, 5 to 10 or longer. You want to hold it to give it time to, if it does go down, to recover and maybe pay a dividend or things along the way. But you're really buying and not incurring lots of extra transaction costs or anything. You're buying that stock with the idea that you're going to hold that stock for a long period of time. So the advantages of buy and hold is, one, it's easier to manage. You're not constantly buying and selling stocks. You buy it, you hold it, you put it off the side, maybe you buy another one down the road, or you buy a mutual fund, whatever it might be, and you're letting it ride, so to speak. So you're easier to manage that. You have great reduced transaction fees, because every time you buy something and sell something, particularly an individual stock, every time you buy an individual stock and sell an individual stock, there's a cost, there's a trading cost or a fee that's associated with that. So the more active trading you do, more buying and selling of stocks, the more fees that you're accruing each time along the way. If you buy it and hold it, well, heck, then you have really reduced those transaction fees really, really dramatically. Better tax efficiency too, because every time you buy something and then sell it, whatever you have for a gain is then taxed. Your gains are taxed. So by buying something and holding it, let it gain over a long period of time, it might be more tax efficient for you to then sell later on. A lot of people use a strategy like, I'll buy now and then I'll hold it till I'm maybe in retirement, where my income is lower and my tax bracket is lower, and thus I'll be more efficient when I do eventually sell them. But until that time, they're basically growing tax-free, and if it's an individual stock. Mutual funds a little bit different, where they have distributions and they do stuff every year to kind of true up. But either way, with buying and holding, the idea is it could be more tax efficient. And the other part of buying and holding is you have a philosophy that you're not trying to time the market. You're not trying to buy when the market's down or individual stocks are down so you can then sell them at a high, because timing the market in history shows this over and over and over again, and some of the best investors out there talk about how hard it is to time the market. When the market's going to go up or go down, or individual stocks go up or go down. You can evaluate and do fundamentals to buy certain things that when they're particularly down, an individual thing, or maybe it's something that's good for the long term, and that's what a buy and hold person is looking for, is the long term. But you're not doing like constant trading when you're trying to time the market. When the market's down, you're buying, and when the market's up, you're selling, and you're constantly researching and doing a lot of that. Buy and hold is like holding, being passive, and letting compounding and letting all these things, time work to your advantage so you can, be very successful. The disadvantages of buy and hold is you might miss out on opportunities. Maybe something's way down and you'd rather sell something so you could buy something else. You can do that with buy and hold, but the idea is you're buying and holding for long periods of time. So you might miss out on some opportunities. And you also, buy and hold, you might be reluctant to sell poor performers quickly enough. Sometimes with a buy and hold investor, they'll buy and hold it and they'll just keep holding and holding and holding. And if something happens with an individual stock, let's say, where it's really going bankrupt or getting crushed or whatever, maybe it is time to get out. But a buy and hold person might be a little bit more reluctant to do that because they bought with the idea of holding for a long period of time, and they're maybe hoping that that will recover. So even buy and hold investors have to bite the bullet sometimes and liquidate things as if something turns bad for a mutual fund or an individual stock. You might buy, let's say, an actively managed mutual fund because you like that fund manager and you think they're doing a terrific job. But once that person maybe leaves the company or retires, you can't keep holding it. And you've got to really look closely at that and say, maybe now's the time to sell that fund because we have a new person coming in. Part of the evaluation of it, or an individual stock, the same thing. So buy and hold is about holding and holding for a long time to compounding and tax efficiency and all that, and reducing fees work for you. The other extreme is actively trading. We're not buying and holding. The idea is that you're making lots of changes. You're looking for these new opportunities. It doesn't necessarily mean you're trading constantly or daily. There's something called day trading where they're basically trading hourly in some cases. But it's something that with regular active trading, you're looking to trade and sell frequently. You've got to be more engaged with the market, understanding what's going on, understand the positions that you hold as far as individual stocks or mutual funds, and really stay on top of that with active trading. And so you can take advantage of new opportunities that you might see coming around. And then you can sell those losers, real quickly. That's an advantage. That's another advantage. You can sell those losers really, really quickly. And if a winner has a quick run up, you can get out fast too and capture that income, capture that gain before it comes back down is the idea too. So you can sell losers, capture gains on winners, and you can reallocate too, particularly faster in a volatile market where stocks going up and down all over the place. Maybe a sector, healthcare's gone way up, you can sell that and you can buy that energy sector that's down, or vice versa, or those individual stocks. So you're actively more engaged in trading. And that's the thing, you're not buying and holding and forgetting it, you're actively trading, you're actively involved all the time. And that's part of the disadvantages to it is you need more time devoted to your investing. So if you have a lot of time to that and you like trading and you want to do some of that, go ahead. Just understand to do it well, it takes a lot more time. And it is very difficult to time the market. I'm not going to say to anybody that you can time the market. The experts are saying that you can't time the market, but you can have buying and selling opportunities. But the idea is you're going to need more time devoted to investing to really be on top of it. You're going to experience, with the disadvantages, is increased taxes, increased fees. So your buying and selling has to outperform that. That's like when we learn about mutual funds, how index funds do well with very low turnover, very low buying and selling, so they have lower fees, lower active managed people managing it, so lower fees because they don't have somebody investing the time in it. Same thing as think of yourself as a mutual fund, but now you're investing your time to manage that fund, your investments, but also you're incurring taxes and fees with all those changes you make. So you need to outperform those extra fees that you'll incur. And really, investing overall really rewards patience and compounding, especially over the long term, where in active trading, is a little bit disadvantaged. It's a little bit less patient with that. And active investing will typically underperform in the long term. I mean, we see that in the experts. I mean, you see these experts, high-paid people in mutual funds. They run these big mutual funds with millions and millions and millions of dollars, and they can't outperform their index, right? So few outperform their index. How can a question to ask yourself, how can I, as the individual investor, how can I do better than those experts who can't outperform the index or outperform a mutual fund? Now, how am I going to do that with active trading? So it's something to think about when you're thinking about active trading. For myself, just to share a little bit, I'm a big believer in buy and hold. I will say that. I like to hold things, hold them for long periods of time. I'm a big believer in buy and hold. I try to make sure I sell if something's going wrong or something changes, because I buy and hold with the idea that a mutual fund or a company is going in a certain direction, but if all of a sudden they change and they make a change from their business strategy or a change in leadership, I'll change too. So I'm not locked into that buy and hold. And so I have a little bit of active trader in me, certainly too, more than a little active trader in me. And also I like to buy and sell individual stocks too, more so from fun and more so also from trying to get that little bit extra performance by concentrating on maybe a few stocks as opposed to trying to build my whole portfolio and actively managing all the time. I got a lot of other stuff going on in my life with family, friends, making videos like this. So I can't be all my time being an investor. So I like buy and hold. I think it proves itself over time. It has served me very well. And a little active trading is fun on the side too as well. So think about yourself and your own personality and the time you have and your education and completing this course and other courses or readings to see if you want to be more of an active trader or maybe of the buy and hold. But those are the extremes, and then within those extremes there's lots of different strategies and tactics you can use to get the best out of your investments. When you're deciding on what types of stocks to choose, one thing you can look at is growth stocks or growth investing versus, let's say, value or income type investing. So growth stocks or growth stocks are ones that are going to be priced higher to the market or in their industry. The whole idea is these are high-flying stocks that you think will have a great future. Maybe they're a high technology company that's working on some kind of new technology, maybe around some new demographics or things around virtual reality or augmented reality, whatever it might be. Or it's a pharmaceutical company, maybe a small pharmaceutical company that's working on the next blockbuster drug or wonder drug, whichever it might be. And it can be in any industry. You're looking for stocks that are going to grow relative to their peers much, much faster. And we mean by growth, not only are they going to grow their sales and their revenue, and hopefully they're going to grow their profits and their earnings, which means it's going to grow the stock price. So with growth stocks, you're really looking for stocks that are going to grow your stock price. You're going to buy here, you're going to buy low, and you're hoping they're going to grow fast and outperform the market, so later you can sell high and make a profit there. You know, these are stocks that don't necessarily pay like dividends or income or anything because they're trying to invest in that growth. So growth stocks are priced to be high to the market. You're looking for that momentum and that future to drive their price up. And they may not even be profitable yet. So they might be running, negative or hanging on there, so to speak, because they're investing in their company and they're looking to, then maybe come to market with something new. So they might not be profitable yet. Growth stocks are great for the long-term investor because you're really betting on that future. You're looking for that great future. So you need to be a long-term investor, and you need to be patient too. These are not overnight sensations typically. Sure, things happen, and when something gets announced, maybe the stock will rise dramatically, but it takes years maybe to get to that point, and you want to be in before that big announcement or maybe before that blockbuster drug is released or whatever it might be. So growth stocks could be something that might take some patience over a longer period of time. Also, growth stocks tend to be a lot more volatile or go up and down price a lot. They're more of a roller coaster because people are betting whether it's going to be great, or if they don't see it's going to be great, then they're going to pull out right away and maybe try to bet on the next great thing. Or there might be a bad announcement. Maybe they're delayed in their process for whatever they're working on that a lot of people are excited about the future for them, and maybe there's a bad announcement or a delay. So they can go up and down in price pretty dramatically at times. The idea is you also want to protect your downside. And we mean by that, if stocks are really kind of going down, 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 even a growth stock, you might want to get out because it might not ever come back. I've seen reports where they talk about if you're down 20%, maybe that's the time to get out. Well, heck, maybe it's time to get out when you're down 2, 3, 4%. But there comes a period where you got to look at it and say, boy, this is way down, and I'm never going to recoup my money back, and maybe this just isn't going to work out as a growth stock. And you do all your fundamentals, you do your continual analysis. Maybe you're looking around at other companies, and you just have to bite the bullet, so to speak, and take those losses. So understand with growth stocks, they can have a great potential, but they can also have a bigger downside. So be aware about that and protect your downside. What you're looking at from a fundamental standpoint, or maybe like financial ratios and things, is that they have fast rising sales and earnings. The whole idea is that they're growing quickly. They're outperforming the market. So when you're comparing within an industry and compare to the market, but really compare within their industry, technology, health, energy, whatever it might be, see that they should be growing their sales and their earnings faster than their peers. And we get in the ratio area, we'll talk about that more. But growth stocks, grow faster sales and earnings. Also look for growth stocks that have low debt. That doesn't mean they necessarily have no debt. Debt's okay because they're taking on debt to help fuel that growth. But if they take on too much debt and they're not growing their earnings, or maybe they haven't had earnings yet, or they're not growing their sales quick enough, they might have a hard time servicing that debt or basically paying off that debt. And that could hurt them and hurt their results and really maybe constrain their growth because they're too busy trying to pay off that debt. It didn't turn out the way they wanted to. But some debt's okay, just so it's not a high level of debt compared to the industry and their peers. And the lower the debt, the better in this case for growth stocks, looking to ride that sales and hopefully earnings ramp up and not always up and down, and certainly not down. So from a ratio standpoint, look for that. A couple tips around growth stock investing and some things to look for. One is think about the industry as a whole. If you're a growth stock, but you're in a bad industry or a poor performing industry, you might be great, but the industry is going to hold you back. You won't have that. Investors will look at that industry and maybe stay away from it just because they don't like the industry at all at that point of time. You could be a growth stock, let's say in the buggy making industry for making buggies for horses, and you could be like, wow, I'm the best at making buggies, and we got a brand new buggy coming out. It's going to be terrific. But you know what? Nobody's really excited about the buggy making industry versus, let's say, maybe an alternative fuel car, whether it's electric, but even getting things like hydrogen cars or solar cars or self-driving cars. Those are the high-tech industries for those that people are excited about and want to invest in that. So if you're a growth company in that industry and things look great for you, you're going to get a lot more investors and that'll drive your stock up. So look for growing industries as a whole. So that's one thing you can look at as you're evaluating growth stocks. So think about the growing industry. Think about also trends that are out there. Some of that qualitative data. What's going on in the market? What's going on in the world? What are you seeing? What are you just kind of observing in the world around you? Or maybe you're seeing some facts and figures coming from think tanks or government sources or education, research or whatever, showing here's some big trends that are happening in the world, some big mega trends that are happening in the world. So, for example, you have a lot of folks in the baby boomer generation, right? The older generation that are retiring now. So that's a growth area for people who might manage money for people who are retiring, and how to get more income and manage money for that might be a growing area. Or it might be a growth area for pharmaceuticals or medical technology firms. There's a trend is there's a lot of older folks, a lot of boomers out there, and they're living longer, which is another big mega trend, which is terrific for all of us that we're all living longer. But it's terrific if you're making things to help ease that life or help maybe people to live longer. Those could be great growth stocks in the areas of like healthcare or biotechnology, whatever it might be. So those are some trends that we're seeing now. And as well as on the other spectrum, where there's a large amount of millennials out there now. There's, what does that mean for how do they act and how are they different than maybe the boomer generation? And you can go beyond just trends of people and demographics. Look at other trends from technology to what might be happening in the world around trends, from eating trends to everything that's out there. Globalization certainly is a big trend that's going to be impacting us for many, many years to come. How can you play in a globalized market, for example? And how can a company be globalized or ramp up quickly too as well, as far as looking at these overall trends? Another is to think about if that growth stock has a strong brand, which would be kind of a barrier to entry. If they're the first mover, let's say in an industry, or at least in a segment of the industry, and they've got it kind of nailed, and they're doing great, and they're growing fast, that first mover advantage can be very, very strong. It's a barrier to entry for others to come in. And there will be competitors and others will come in, it's just they might be more reluctant to go take on somebody who's really dominating an area and really growing. I mean, think about how much energy does it take, how much resources does it take to compete against like Google in search or Facebook with social media. I mean, these are big moving companies who are they're growth companies, and it's hard to compete against them. Doesn't mean you can't find your niche and maybe take little pieces away from them. Just saying if you're going to compete head to head, that would be a barrier to entry versus something that it's easy to maybe get involved with, maybe a local restaurant or something of that nature. Another thing for growth stocks, and that maybe have been growing for some time, is look at what the insiders are doing. What are the management team, the CEOs and the executive team, what are they buying? And we have a section on insider trading which talks about how to look at, and how to see where people are buying and selling at the top level. But you can go waste online, Yahoo Finance, or go onto the annual report or go onto their site, and you'll see publications or things that shows whether they're buying or selling stock. So if they're buying lots of stock, that's another good trend for a growth stock. If they're all piling out and cashing in, but maybe they're piling out because things are going to maybe look bad in the next couple upcoming months, that's something just to be aware of. Doesn't mean if they're cashing in, maybe they're just trying to take that money out for themselves personally. But if everybody's piling out, that's a warning sign. So just be aware of what the insiders are doing. And then lastly, from just an overall fundamentals type thing, some guidelines. These are not hard or fast, but some guidelines when you're evaluating growth stocks that can maybe help you as far as evaluating them and evaluating them against their peers in the industry. One is we talked about sales increasing and earnings increasing. Well, they should be at least increasing by 10% or more per year is a good guideline to use. So if they're growing even faster than that, great. But if they're really only growing like 1, 2, 3%, heck, if they're growing like 1%, they're not even keeping up with inflation. Well, they're not really a growth stock and shouldn't be evaluated as such. Maybe they're a good income stock, but they're not a growth stock. So look for sales and earnings rising above 10%. And then look for, debt that's decreasing debt, at least lower than the previous year. Look at like their debt ratio and look at the amount of debt that they're carrying. And if they're continuing to add debt on top of debt, well, they might be having a hard time paying their debt, but also financing their operations. So they're kind of like taking out extra debt to try to, make it all work. And in the end, if you pile on too much debt, well, then it's like a house of cards that'll all fall down. So be aware of anybody who's increasing their debt year over year. If they're decreasing their debt and they've got sales and earnings that are rapidly growing, hey, that's a great sign as far as some things in growth stocks. And lastly, look at ROE or return on equity about 10% plus as well. It's another way to show how is your investment, your equity, what are you putting into the firm, the equity that's going in the firm, how is your return coming on that? And looking at that 10% or more when you look at the ROE figure. And we'll look at that in all the whole ratio section. But here's some good fundamental things to look at when you're looking at growth stocks. And and some growth stocks might, like I said, might not even have earnings yet, so they might not be making 10% or more a year. It doesn't mean their stock won't go up. Amazon, those kind of companies. It doesn't mean their stock doesn't go up. Just it's something to look at when you're looking at growth stocks and some good rules of thumb and guidelines around ratios. So if we use some examples of growth stocks to wrap up this section, household names that you would know would be categorized in this, like Amazon and Facebook and Apple, of course, and Biogen and Uber, right? Uber is new and growing. It's a kind of this new thing. And Starbucks, of course, is continuing to grow and adding. At some point they'll grow so far they might become more of an income stock or they might plateau. We'll see. But they're considered a growth stock. But Uber is a good example where it's a tech stock. Really, it's a tech stock that does, ride services, cab services. Really, a new way to kind of look at that. It's it's new. It's in its infant stages still, and it's really kind of growing. And it's got a lot of markets it can still get into and grow. Doesn't mean it doesn't have issues like regulatory issues and all those things. And some countries adopt, some don't. Unions in some countries are opposing it for the taxi unions versus Uber and how Uber works. So those are things to take into consideration when you look at. But they would be like a growth stock like these other ones as well. So growth stocks, to wrap up, great for long-term investors. That's the idea. You want to get that capital appreciation, buy low and sell high, and maybe your next stock will be if somebody bought Apple at $5 and now look how big it is with many stock splits along the way. So that's what you're hopefully going to be for you when you look at growth stocks. When we look at income stocks, they're also many times known as dividend stocks because they're paying a dividend. Income stocks, really the idea behind them is they're going to pay you money. They're going to pay you a dividend. They're going to pay you income. So if I own the stock, just by holding it, they're going to basically pay me, typically on a quarterly basis, a stream of income based on a dividend. And that's a great thing, right? I just buy the stock, I own it, and they give me money. What a wonderful world, right? And that's one reason that dividend stocks or income stocks are very, very popular. They won't grow as fast as far as their capital appreciation, your price, what you paid for it, and what you can potentially sell it for. It won't grow as fast as, let's say, a growth stock. That's the idea of growth stocks, is that capital appreciation. But growth stocks are not paying that dividend. They're using anything they could pay in a dividend to finance their operations and continue to invest in their company. Where an income stock might not grow as much as far as the capital, the price of the stock, but it's going to grow by giving you dividends and then growing those dividends and consistently paying those dividends. So they're a great way to get current income in there from income and dividend producing stocks. They're great for retirees. Is a very common way. It was always the traditional way that retirees would have a basket of bonds and cash and then maybe some dividend stocks. Now that people are living longer, you're actually seeing retirees with more growth stocks in addition to income stocks in their portfolios because they're living a longer period of time, which is terrific for all of us, hopefully. So retirees are depending on that income, so they own these growth stocks, they get a little price appreciation, but then they're getting that quarterly check that they use then to, finance their life, go on vacation, buy things, groceries, whatever it might be, or continue to invest. So they're great for retirees. They're also great in a low interest environment. And why is that? We've been in a period of very low, record low interest rates for a long period of time. When you have low interest rates, when people buy things or invest in things like treasury bonds or cash or other types of bonds, government bonds, corporate bonds, the interest rates are low, right? That's the low interest rate environment. So people are not getting the return they're looking from those low interest rates on things like bonds and cash. So they're looking for alternative ways to get income coming in, maybe at a better rate with maybe some capital appreciation. And that's where dividend stocks come in. It's like if I'm going to get only 2% or 1% of my cash, why not take that cash and invest in a dividend stock that might be pay me 2 or 3% in dividends or dividend in yield. So I'm going to get 2 or 3%, and then I might have the stock go up over time. Like, that seems almost like a no-brainer in a lot of ways. Now, the stock could go down. They could cut the dividend. There's more risk. We get that. But that's one reason people like dividend stocks in a low interest rate environment. By the same token, it can be risky, or it's less popular in a very high interest rate environment because you can get your return or that income from other sources than stocks or dividend paying stocks. So be wary if we're in a low interest environment and it rises quickly, that might impact or hurt dividend paying stocks. But low interest rate environment, they're great. Also, they're great for more risk adverse investors. People who don't like that volatility, the stock continually going up and down. Now, dividend stocks can go up and down. Sometimes they can go up and down in big swings, but the idea is they don't. They're more those large long-term companies, steady eddies, who always pay a dividend. That's kind of what you're looking for. And they're just steady, good companies versus maybe a growth stock that might be a great payoff in the future, but it might be real volatile in the near term, and maybe it never takes off and it just becomes a dog and hurts you overall, and you got to sell it at a loss. So if you're looking for something that's less risky than a growth stock, then look at these income or dividend stocks. They're typically large cap stocks because these are big companies that are then paying a dividend. And so you'll find them typically in large cap. You can find some small, mid cap, but rare. It's mostly all the large cap brand names, like Coke and Exxon and all that. You're looking for consistent dividend payouts too as well. Sometimes companies get in trouble or they struggle to make their dividend payouts and they might cut their dividend or eliminate their dividend. When that happens, you get less income coming in, which hurts you. But also by them doing that, their actual stock price goes plummeting because people are investing in those companies because they want the dividends. So dividend paying stocks try not to ever cut their dividend if they don't have to. It happened, especially in like 2008, 2009 during the Great Recession, that many really good companies cut their dividend and it really impacted them overall. So be aware of that and look for those companies that pay these consistent dividends out over many years, 5, 10, well, more than 5 or 10, think 10 or more years, 20 years. There are some that pay even much longer than that, and those are great consistent dividend paying stocks. Okay, so let's look at some tips around income paying or dividend stocks. One is look for companies that are very stable. Not only are they stable as a company, but their industry is stable as well. I mean, you could be a stable company, but in a real screwed up or volatile industry, that's going to affect them negatively. So look for good, solid, stable companies that have been growing and doing great for a long time and paying those dividends for a long time, and maybe in a real stable, normal type of industry versus something, crazy or wacky that's more of a growth industry. So stable companies, stable industry that can pay those consistent dividends. Use the same fundamental analysis and ratios and things to evaluate dividend paying stocks like you would any stock. But there's a couple of them you want to key in on for income and dividend paying stocks in particular and really look closely at. One is the dividend yield. You might see it when you look at quotes and things, you'll see dividend yield, and we talk about this later in the ratio section. But dividend yield, which is basically looking at if I buy that stock and it's going to pay me a dividend, it's going to pay me income, what is the percentage on that? What in effect interest rate might be a way to look at, is it equivalent to? So if I've got cash paying me 1% and the dividend yield on a company is 2%, well, I'm making more money just on the yield, or making more money just on the payments they're sending me, just like interest on a cash account, or savings account, they're paying me cash directly in the form of dividends and at a rate of 2%. So I can then compare them. Now remember, they can raise or lower dividends at any time, so it's more risky than something you might lock into like a CD or a treasury note or something like that in terms of cash. So they're going to pay that income, and then you can look at the yield. You also want to look at the dividend growth rate, which means not that the stock is growing. Hopefully it does that. The stock price appreciates, or capital appreciation. But you want the dividend to grow as well, what they're actually paying you. And they do over time, some more than others. So it's not a consistent flat rate that you own forever. The dividends will grow each year as well, some faster than others. So a good growth rate will not only, it'll kind of give you that great double whammy. You get that consistent income each quarter, but then every year it goes up a little bit more. So then that following year you get a little bit more. And the year after that you get a little bit more, and then a little bit more. So after 10, 15 years maybe of holding a dividend stock, what you paid, you're getting a lot more income than you did originally. And isn't that a good thing? It's appreciating. You're looking for those consistent dividends, of course, so look at their dividend payout history. You see if they've, a lot of companies will tout that we've paid a dividend for 20 straight years or 30 straight years or whatever. So look for those types of things, maybe an annual report or looking at, history of dividend payouts. So you can search for that and see that they're consistently paying that dividend. And then the last thing that's a little bit of sneaky number, but real important that gets missed a lot is the dividend payout ratio. And compare it with its peers in the industry, overall market too, but really look at the peers in the industry. And what that ratio means is it's looking at the earnings or the cash that is coming in a period and how much of that is getting paid out in dividends, right? They can take all those earnings once all their assets, all their expenses are done, their revenue, their sales, they have their expenses, whatever's left over is their income. How much of that is getting paid out in the form of dividends? And then how much is going used to invest in other things in the company or finance other operations? The reason the payout ratio is important is if companies are struggling and they're either losing money in a period or a period of time or they're struggling to make ends meet, well, one thing that they could cut is dividends. Remember, that's free money that's basically coming out to you. If they cut or eliminate their dividend, that's money they're now keeping in the company, and then they can then use it to right the ship or invest in themselves. Now, companies that pay dividends hate to do that because if they reduce or cut the dividend, everybody who bought into that company looking for dividends immediately runs out the door and their stock price just goes plummeting. So they really don't like to cut dividends, which is good for you and me. So the payout ratio is showing that percentage of their income they're paying out in dividends, and you want that number to be as low as possible. So if it's, like, say, anywhere from 0%, of course, would be, well, not 0%, but let's say 50 to 70% of their income if they're paying out in dividends as a dividend-paying stock, that's pretty good. More towards the 50, 60 range is good. Sure, they're paying out half or a little more in dividends. That's okay. That's what they're there for. They're a dividend-paying company. They're focused on that. A lot of utilities will pay much more than that. For example, like oil or gas or electric companies will pay more than that. And that's okay. Just look at how their industry peers are doing. If you start getting about 70% in payout, that's a lot going out. That's a little more concerning. Especially if you start getting the 80% plus of income coming in is going right out in the form of dividends. Well, that makes it real hard to withstand a shock to the system or a bump in the road or a decrease in sales or something that happens. They're really living on the edge then. So if you're investing in companies, watch out for any that are paying 80% or more in particular in a payout ratio. And really, if you're in a volatile industry, or looking at different stocks in a volatile industry, those ones that have a lower payout ratio can be better. Even if they're paying out less in yield, it might be a better investment because it's going to be more consistent and more safe. So that's something to consider as well. So there's lots of companies that pay out dividends. Let's take a look at some examples here. And there are really a lot of them are household names, right? They're the products you might use every day are these big, long-term, Fortune 500 large international companies that pay out these dividends. And some may pay out for a long period of time. I've got an example here. A long time paying dividend stock is Johnson & Johnson. They make Band-Aids and they do medical equipment. They do things related in the health industry. Things that you might even be buying yourself in the grocery store every day or in the market related to health type things. Johnson & Johnson is really involved with that. So with Johnson & Johnson, they've been around, 50, 60, 70, 80 years, a long time, and they've been paying out dividends consistently for the last 53 years and have been growing those dividends every year for 53 years. I mean, think about how consistent that is, that they've been growing dividends for 53 years. And they were founded in 1886, and they've been paying out dividends for 100 years. So in 100 years and more now, they have been paying out a dividend. In the last 53 years, every year in the last 53, they've grew their dividends, so they pay a little bit more each year on that dividend. What a great, consistent company. And their payout ratio tends to typically be around 50%. So it's a very popular stock as far as people want that consistent dividends. Now, there's no guarantees, and Johnson & Johnson gets sued all the time, by the way, because they're involved in medical devices, pharmaceuticals, a lot of things that can lead to problems or issues if something goes wrong. So be aware of that. Their stock price could drop anytime, their income could drop anytime. But if you're looking for somebody who's been, at least has a proven track record, well, there's a good example of one, and there's others out there that have these long time growing dividends. And if you're looking for the safety, that's maybe a great place to look, is for those type of companies that have been paying out dividends for 20, 30 years or more. So are examples of companies that have been doing dividends for a long time. Procter & Gamble, it makes like toothpaste and all that stuff. A lot of stuff you buy at the store. They own Gillette, which makes razors and things. They bought the Gillette company, so they own do razors and stuff like that for men's razors and women's razors. So they do a lot of products. You go to procterandgamble.com and just look at their product offerings. You'd be amazed at all the stuff they offer. So Procter & Gamble have been paying dividends a long time. General Mills, which makes cereal and other products like Cheerios, Lucky Charms, they're making cereals. Wells Fargo, a big bank here in the United States, makes is a bank. They have hundreds and hundreds and hundreds of retail locations, plus they do mortgages and other things. So paying out dividends a long time. Company you might not be familiar with is there's a lot of utility companies out there, and that's where a lot of people go for dividends, because utility companies by law, at least in some countries, have to pay out a certain amount in dividends out and have to pay that, or they look to do that. They don't have to, I guess, but that's their main focus, is paying that out, and are known for that. So like Xcel Energy does coal, but does energy. They sell energy to households and businesses through the North and Midwest some of the western states in the United States. So they're very good there, and they are involved now in alternative energy too, like wind farms and things. Have been heavily investing in that, some nuclear energy, but a lot of it is electricity. So as a utility company, they have paid out a dividend for a long time, but during the 2008-2009, they cut their dividend, and that really impacted their stock in a negative way. And now they're back to paying dividends and been paying them pretty well. So Xcel Energy would have been an example of a utility company, and then others are out there like ExxonMobil, big oil and gas company, energy companies. A lot of those will pay out pretty good dividends too, as a yield or percentage. Once again, the stock price could go up or down at any time. How much they pay in dividends could go up and down at any time. They could stop paying a dividend at any time. So be aware, there is risk there, more risk than something like a bond or cash. They are still a stock, but they're a less risky stock than maybe like a growth stock or an undervalued stock. So if you're looking for income and maybe some growth, dividends might be, and dividend paying or income stocks might be the way to go for you. Let's talk about value investing as compared to like growth stocks, where you want that price in the sales and earnings of the company to grow rapidly over a period of time. You're looking for that long-term, that big growth number, or income stocks that are paying dividends and regularly paying dividends. Value stocks are something that's a little bit different, more of a contrarian approach. Now, sometimes when you look at, let's say, especially mutual funds, they might, in their style box, talk about growth stocks that might be in a stock mutual fund and value stocks. But it's really more about value in their case, talking about a value stock. They're considering one that's paying a dividend and more dividend payers. So value and dividends can kind of work the same way, or income. So just be aware whether they're comparing the same way. It might not necessarily be an undervalued company. It might actually be a very strong company that's been paying out a dividend a long time. So you got growth, you get income. Sometimes in mutual funds, they'll associate value with income. But what we want to talk about, how we associate value investing, and you might see other courses and things around value investing, is that's what you're looking for is undervalued organizations or companies. You evaluate companies, you put a value on them, and some might be undervalued, or they're hidden gems, right? That's what you're looking for, is this something has happened, and some reason they're undervalued, their stock price is lower than it should be, and it's a great opportunity to kind of buy low. And the market has undervalued them for some reason. Maybe there was some recent bad news, right? Maybe things have been going good, but they announced some bad news and had to close some locations, or their new product is not doing as well as they thought, or whatever. There's some recent bad news that drives the stock price down. And maybe their long-term fundamentals is good, but that recent bad news has really devalued their stock price, so it might be a hidden gem and it's on sale, so to speak, so you can go in and buy this undervalued company on sale. So I think value investing, you're really looking for undervalued stocks that you think will really grow in the market, and you're kind of getting that built-in cushion of a return because they're lower than what they should be, is the idea. So to find some undervalued stocks, some key ratios just to start with as far as what to compare to the average within their industry and to their peers is what you want to look at. And these are some ratios. We'll talk more about ratios in great detail, but just to give you an idea of a starting point, you're looking for value stocks that might have a lower price to book ratio than their peers in the industry. Price to book is really talking about, if you were to take their assets and take out their liabilities and say, well, the company is really worth this. This is their book price. If they were to sell the company to another company or liquidate the company, just liquidate it all and sell it all off and sell all the assets like a big garage sale or yard sale, you're just selling everything off, that would be the price in comparison to that book value. What is it book value worth? So that would be, if it's a lower price to book, well, that means that it's undervalued in comparison to really what its underlying assets are. I mean, I've seen retailers, I've gone way down, it's like, gosh, if you just sold all the inventory, you would make up, what their price should be in terms of a stock thing. They have such a low price to book value. So sometimes that can be an opportunity. So look for a low price to book value. You're looking for a low PE ratio or low price to earnings. So, high price to earning stocks will tend to be those growth stocks. People are paying a higher price in comparison to the earnings that company is actually driving because they're expecting that future growth. Well, an underperformer or an undervalued, I should say, maybe it's a good performer still, but it's undervalued in terms of price or in stock price, will have a low price to earnings. Maybe they got great earnings, but their stock price has been driven down for some reason recently. Maybe it's that bad news or something. If the company happens to pay a dividend, it will have a high dividend yield. Where yield, we're looking at the percentage of dividend paid out compared to its price. So it'd have a high dividend yield because the price has come down, but the dividend is the same. So you're actually getting more for your money. The percentage you're going to get out is going to be better because the price has come down on that side of the equation. Companies that have rapidly rising prices as far as their stock price have lower dividend yields. So compare it within the industry once again. And look at things like the future. What's the future look like? What's the growth look like? What's their cash flow looking right? Is their cash flow good? Are they able to pay their bills? They have low debt? Things like that might also be good signs around a value investing strategy. And the whole idea of value investing is it's a real contrarian strategy. You might even hear called contrarian strategy, contrarian being opposite, right? If the market says this stock's no good, it's a dog, let's drive the price down, people are selling like crazy, well, and you're the one saying, no, market's making a mistake here, I'm going to buy into this because it's just getting driven down way too low. I think there's a good upside in this stock for a variety of reasons. And we'll look at an example here in a moment, one from my own life that I can share with you. But that's the idea that you're kind of doing the opposite of what the market is saying. So it can be very subjective if you think about it. Sure, we can look at ratios. Sure, we can do a lot of detailed analysis. But in the end, you think it's undervalued. Others think it's overvalued and they're trying to get out of it. I mean, you think about just that its nature of stock trade. It's somebody who's selling a stock for whatever reason. They don't think it's any good anymore. They're going to do some other things. And there's somebody buying. It's a trade. There's always a buyer and seller. So if you think it's undervalued and you want to buy, that means there's somebody else on the other end who thinks, no, it's not so good. I want to sell it. And they're looking to get rid of it. So they think it's going to go down further, and you think, well, hopefully it's going to go up. And it's also like one thing with value stocks or contrarian investing, it's hard to time the market. It's very impossible to time the market and to buy at the absolute rock bottom, right? So it's hard to do that, real hard to do that. Experts can't do that. I mean, people do this for a living. Professional people sit in the Wall Street office all day long trying to do that, not successful with it. But you try to buy maybe near the bottom is great with a contrarian or value investing strategy. So don't be surprised if you're taking a bet on a company, on a contrarian or underperforming company, that it goes down for a period of time right after that. That's natural. That's normal. It might go down as it reaches its bottom for a few months, maybe a few years, for all you know. But if it's a long-term thing, it might be so high in the long term, especially if you're looking at holding something like a buy and hold investor and you want to hold it for 10 years, well, you got a lot of time for that to make it up. If you really think it's a great stock that's just been, in the shorter term, whatever the shorter term is, been undervalued. So value investing is great if you like to buy low and sell high. Well, I guess who doesn't, right? If you like risk, because they can be risky, because they could be on that elevator down or that lift going down, and they just continue to go down. They never come back, and you got to get out and capture what you can, because maybe they were a dog, and sometimes that happens. And you want to let time work for you. If it really does go down a bit and then turns around and you're now coming up, you want to let that time, reap the reward of that time, and then you sell it later when it's reached more of a peak or start on that upper end. Once again, you can't really predict the very top or the very bottom, but you're in that range and you're trying to buy it at the low end of the range. So value investing, these are underperforming companies in the market saying that. They could be growth companies that were growing and now they're a fallen star. They're not growing as fast anymore and people are getting out, so they're getting out of a growth company. They could be a large income or dividend company that has struggled, or maybe they're struggling in making their dividend or whatever, and now they've gone down in value and people are saying, oh heck, maybe they'll come back, and they're investing in them. A lot of times you might see that also after with a large dividend or income company where they're paying out a dividend. If they've had bad times and they cut their dividend, especially in that Great Recession, 2008, 2009, we saw lots of companies cutting their dividend who were good companies. They were just trying to do things to kind of stay afloat a little bit and make the cash flow a little bit better. And if you bought into some of those during that period, their price might have gone way down because they cut their dividend immediately. The stock drops. Well, maybe you get in, and if you're patient, it might come back and they might start raising their dividends again. And then you're now bought low and could sell high or reap the benefits of this dividend by buying it at basically a lower yield or lower dividend yield or at a lower rate because the stock price dropped. So value investing, I do a lot. It's great, and but it's not for the faint of heart because it could continue to go down. So look at some of these ratios, look at some of these things, and in the end, you got to say to yourself, I just think this company is going to do better. I've done some due diligence. I've done this research. I think there's people making a mistake. I'm going to take a risk on it, and I want to buy this company that's on sale. Okay, so let's look at a value investing or contrarian investing case study or example. And this is a real life example from my own life. I actually bought this stock, and we're going to go in good detail on what my thought process was and what I bought it at and what's that now and all that. So you can kind of see the process behind buying this contrarian or value stock. And you can see how it gets to be really subjective in a lot of ways as well. I still own the stock and it's done well for me, but I could sell it any time, so like any stock. So I'm not making any stock recommendations, by the way. I'm just want to use this as an example of a process. This might not be the right stock for you or anything. Heck, like I said, I could sell it at any moment. So it's not a stock recommendation. It's really a tool to use to understand value investing a little bit more. Just a quick example. Okay, so let's take a look at the example. This is with Wells Fargo. The ticker is WFC. If you go into quote and put in WFC, like in a Yahoo Finance or whatever, it'll be Wells Fargo. And Wells Fargo, if you're not familiar with them, is a large banking institution in the United States. All right, so they're headquartered out of San Francisco, I believe. They used to have a big company called Norwest that was in Minneapolis, and they bought them, and they bought other people all around the way. So they're a big bank company. And I bought them in 2009. So I made an investment in Wells Fargo, individual stock, bought some in 2009, early 2009. So what's going on in 2009? Do we remember what was happening in early 2009? Well, it was the start and really some peak times and bad times of the Great Recession. Globally, it was a Great Recession, and particularly with the United States and particularly with banks, because they're a big part of it, and banking stocks were way down. So, but before that even happened, Wells Fargo was always on my radar as far as a stock that I was interested in. I happened to be a customer of Wells Fargo. I've done a lot of research on them. I know what they do well. I know what their strategy is. So from that whole qualitative just standpoint, understanding the company and understanding the industry a little bit, I was like, yeah, Wells Fargo, I'd like to buy them someday. They're a great stock. And I've had stocks like that have been on my radar that I've never bought because they've never really got to the price range that I've been interested in. But Wells Fargo was one that was always high, but it was always in my range. If it ever went down, maybe I'd buy them. Well, what happened was in 2009, the banking stock sector, the entire industry and sector got crushed, just devastated. And because a big cause of that 2009 period was around the banking sector, right? Remember hearing things about really weird derivative investments that banks were making that they didn't even understand themselves, let alone their customers, that were really strange and actually, caused a lot of problems and caused entire companies to fail. So you have these derivative things, and also you had the subprime home mortgage crisis here, particularly in the United States, where people are giving out mortgages or home loans, and Wells Fargo was a big home loan vendor or bank that does lots of home loans that were to really risky people, right? And they weren't doing their due diligence, and people were defaulting and foreclosing, and there was foreclosures in homes. They couldn't pay the homes, and then the whole economy went down, so people were losing their jobs, so they couldn't pay on their home, which means the banks weren't getting paid. And you had the derivative thing, and people hated the banks, and so bank stocks went way, way down. And so I'm like, oh, well, I've had Wells Fargo on the radar. The banks are getting crushed. Everybody's thinking, got to get out of banking stock. So as a value investor or using this strategy, contrarian, I'm thinking, maybe Wells Fargo is being unusually punished versus maybe some other banks who really deserved to go down, and many went bankrupt, actually. But Wells Fargo, long time, 80, 100-year-old company, strong company. So when I looked at it, I knew Wells Fargo and did more additional research. Wells Fargo was a high-quality bank that did a lot of home loans, but the home loans they did were considered high-quality home loans, not subprime. They did some because they did a little because everybody was making a bunch of money before the bottom or the bubble fell, but they were doing high-quality loans to high-quality prospects, and thus they didn't get caught in that big downdraft of subprime mortgages. poor, results on the mortgages versus others. They had good, high quality mortgages. So they were a lot more solvent than a lot of other banks and doing better. Also, they were a big banking retail banker where they have thousands and thousands of locations across the United States. And so they do business with people come in and do banking, right? They deposit money, they take money out, they do loans, they do all kind of that retail bank. You go to the bank and you do business. That was what Wells Fargo was known for. And from a strategy standpoint that I understood as a customer and doing more research, and having worked in the retail industry for a while too, understanding the concept of upselling, Wells Fargo was tremendous and great and many accolades around upselling. You go into there to the bank and you make a deposit, well, they would make a suggestion like, oh, I see you don't have our credit card. Would you like a Wells Fargo Visa card? Or, oh, I see we have this special on this, home mortgage rate. Would you be interested in that? So they would be making suggestions and selling things inside the bank. And they had really good people who took care of customers and sold stuff. At least my opinion. I've been a long-time customer. Your results with any bank may be different, but that was my experience and what I've been seeing their price appreciate for many years before 2009. Then what also happened right at this time is they bought Wachovia Bank, which had 3,000 locations, a big bank that was frankly poorly run on its retail locations. They were making a ton of money on these subprime mortgages. So when that bottom fell out, they were about to go out of business. Wells Fargo bought them cheap. They got some government assistance even from that, or some special tax breaks that were kind of hidden in there that I found out about and thought, oh, this is pretty good for them. Maybe not great for anybody else, but they bought from some special things because the whole industry was struggling and the U.S. government was trying to prop up the industry. So they got these 3,000 locations on the cheap, and then they could use their expertise to turn them into high-quality Wells Fargo locations. And yeah, whenever there's a merger like that, you've closed some of the underperforming locations, which is tough for the people in those locations, of course, but it's more profitable for the bank. So I saw all these things and said, yeah, banks are struggling. I'm looking at their fundamentals. The rest of their numbers are good. They're not cutting, their dividend seems okay and all this stuff. I'm going to buy Wells Fargo Bank. And I did. So I bought them for, at the time, $32.50. So what happened? They immediately went down further. They were in this big downdraft. And they went down to $27.50, right? And I'm thinking US dollars. And I'm thinking, gosh, I just lost $5 per share, and depending on how many shares you buy, that's could be quite a bit of money. And like, gosh, I'm buying it, with the idea that they're going to come back, they're a solid bank and a long-term strong performer. Well, currently they're at $46, $50. They kind of trade within that range, and they're still paying their dividend. They're paying, the current dividend yield is at 3.2%, much better than you could get with cash or other, safe investments. I bought it since cheaper. I got a better yield actually because I bought it on the cheap. But right now, I've made some capital appreciation. I'm getting a dividend. It's a stock I've wanted to own, and it's been a long-term good player for me, and it's something I'll buy and hold, hopefully for a very, very long time. But if things change, I could sell it at any time. So the whole point of this story or case study, and because sometimes it doesn't always work out, but here's an example of a case study where, yeah, I looked at the fundamentals, but I also did some financial stuff. But I also used kind of my noggin a little bit to think through things. Do I know this industry? Yeah. Do I know this particular bank? Yeah, I've been a customer for a long time, and I've done additional research too about their strategies and their business practices. I saw where their strengths were not necessarily matching up with what was the problem in other banks. I saw them buy Wachovia really on the cheap. That could be a big boost for them once things turned around, and it did. And they did a great job with it. So I saw all these things coming together, and that's where subjectively I could say with my research and everything saying, yeah, I could buy a bank stock, but this one for me is the best one for me. Now, it doesn't mean that weren't other banks that you could have bought at a better price. Maybe they've outperformed Wells Fargo since then. There's some that have gone even worse or gone out of business. I knew this company, and thus I invested in them, and it's turned out well for me. It doesn't always turn out well, and if it didn't, I would sell it, and maybe sell it at a loss. But I want you to take home with this part is just understand that if you want to be a value investor and kind of buy low and maybe someday sell high, that you can see some of the thought process going through here, and you want to have similar thought processes. I mean, if you're looking at an undervalued stock and you say, oh, I looked at the price of the book is low and I see this, that looks good, and that's all you got, I would advise you to know more about the company, know more about their strategy, and really articulate to others or to yourself, but even to others, like, here's why I'm doing this. And so when it went down to $27.50, I was articulating that to my wife. She said, boy, that was a bad bet on Wells Fargo. I would say, no, here's the plan. And it turned around within the year, actually, a few months, actually, and was starting to make money right away. So that's what you want to do as well. So no specific recommendation, but here's the thought process behind it. Okay, so we looked at this case study. Let's go ahead and move on to the next lesson. An interesting strategy that's in between growth and value investing is GARP. And it's interesting because it's a kind of cool kind of name, right? GARP. I'm a GARP investor. So it's kind of strange, I guess. But GARP actually stands for something. It stands for growth at a reasonable price. Right? So think about that. You want growth, but you want it at a reasonable price. You don't want to pay those high price to earnings, high PE ratios. You want something a little bit more reasonable, something a little bit more safe maybe. And that's the idea of GARP, or growth at a reasonable price, is you're looking for growth opportunities, these high flyers, but something a little bit more reasonable, where you're looking maybe for something that's undervalued and for some reason it's recently being punished, that should be, turn around quickly and become a high flyer. So GARP, or growth at a reasonable price, is a combination of growth and value investing. You don't have to be on one extreme or the other. With GARP, it says, well, you could be kind of in between. And you're looking for somewhat undervalued stocks, so you're not looking for the bottom of the barrel, biggest sale stocks that are on the big sale. Maybe you're looking at a little bit better stocks that are undervalued, just not the bottom of the bucket ones, because sometimes those bottom of the bucket, really terrible stocks never do turn around. They just keep going down and go away. Maybe even go bankrupt. Where you're looking for something that's undervalued, but it's not all the way to the bottom. But you want to have, not only is it undervalued, you want it to have a really substantial and sustainable growth potential, right? Some reason it's undervalued, but you want it to grow. It's not necessarily an income stock or anything. You're looking for something that's going to grow, but for some reason it's taken a dip. Something has happened in the news, something has happened in an earnings report, something has happened from a company announcement, something has caused that stock price to dip, and you think, boy, it's undervalued, maybe not terribly, but it's undervalued, but the growth potential is great, so I'm going to apply some GARP principles on there. And we're going to look at some of the ratios and things that are associated with GARP here in just a second. One criticism of GARP, by the way, is you're kind of in between, or it's kind of wishy-washy, right? It's like, if you're going to invest in growth stocks, then just do it. Invest in these great, high-flying, high trajectory growth stocks and just go with those. But if you like undervalued stocks, then go with those and go with the really undervalued stocks, the ones that give you the biggest cushion for it to go up, and things that might have this big turnaround and give you some great price appreciation, maybe even some dividends along the way. Go with the extremes to get the best return. GARP is too much in the middle, and you don't necessarily maximize the return either way with a good growth stock or a good value stock. And that's true. It just doesn't consider the element of risk. Yeah, if I take either end, potential is great at the extremes, but in the middle, I might mitigate my risk by looking at things that are just a little undervalued and maybe have some growth or some good growth, but just not a high flyer or a big underperformer. So how do we evaluate these stocks? Well, like any stock, you look at qualitative and quantitative information. In GARP stocks, that qualitative information is very important. Qualitative being, not quantitative. Quantitative being the numbers, hard, cold numbers, ratios, those types of things. Qualitative is more about, what is the business strategy? What is the executive team saying? What is the CEO saying? Do they have a new CEO? Did the CEO just left? What's going on with the company? What's going on with the industry? What are the trends in the industry? What are the overall demographics and things that might be happening in the global marketplace that might be affecting this organization? What is happening from a qualitative standpoint? And something probably has happened to drive the stock price down. That's why it's in that somewhat undervalued category. If it was way high priced, then it wouldn't be there. It'd be something has happened to maybe cause it to go down, to get on your radar as maybe a valued stock. So that's the first thing. Something has happened to cause it maybe to be more of a value stock, at least somewhat a value stock. And then you want to look at the quantitative aspect of it, the financial or the fundamentals around it, to start evaluating that to see, is it just slightly undervalued with some great growth prospects, or is it really just not a good stock? So quantitatively, just some guidelines and things to use. It can vary by industry, but compare with industry, of course. But one thing to look at is look at its recent, past, and its future growth potentials. That's really what you're looking at, is what's happened recently that's maybe been not so good, negative, but what does the future look like? Does the future look great? Is it like maybe a pharmaceutical or a drug company that just had a bad announcement because of a clinical trial, but they're very confident it's going to turn around and they'll have this great wonder drug. But right now the stock price is getting punished because they announced poor results from a clinical trial, or it's a technology firm that had a setback or something like that. But it'll be great in the end. Those are the kind of recent, past, and future growth you're looking for. The earnings per share will be more subdued. You're looking like a 15-20% range as far as earnings per share versus something like in a growth or in a value stock. So earnings per share is more subdued, and price to earnings is higher than a value stock, but lower than a true growth stock. Once again, maybe in that 15 to 25% range with currently with because we're in a high PE ratio period. Comparing to other industries or other companies within the industry, but look how it compares to its peers. That's maybe slightly higher, a little bit higher from a price to earnings aspect, but it's not way at the top like you might see some of those big growth companies. Another favorite ratio that's used with GARP are growth companies at a reasonable price. And one thing that really a lot of folks who like this strategy really hang their hat on is the PEG value or PEG ratio. And a PEG of less than 1 is something is something they're looking for. It might be something that's nearer to 0.5. And PEG is a favorite measure for GARP is looking at price and earnings in comparison to growth. We'll look at that in the ratio section, but just think right now, PEG of less than 1, something near to 0.5 would be great. And so the whole idea is you're looking for growth, but you're looking for the price to be reasonable, price being the stock price you pay. So, but understand, it's kind of wishy-washy. It's kind of in the between. So if you're not sure you want to take on the big risk of growth stocks or take on the big risk of a really super undervalued value stock that might not ever recover, maybe using some of these principles and understanding that you're looking for growth and value together under GARP might be the way to go. Let's spend a moment and talk about technical analysis as a tool or a strategy to evaluate stocks. You might have also heard this known as charting or maybe momentum investing, all very similar. But really what technical analysis is, or really what it isn't, is it's not looking at fundamentals. Fundamentals investing would look at things like the ratios, for example, price to earnings ratio or PEG ratios or all sorts of different ratios that you can look at, return on equity to return on assets. You name it, there's lots of ratios out there, from debt ratios like debt equity to liquidity like current ratios and those types of things as well. So technical analysis looks at none of those ratios and doesn't care about ratios or doesn't care about how our sales or doesn't care how profits are. It doesn't care about how the company's maybe looking from a qualitative standpoint. It throws all that out the window and is really looking at it from a charting or prediction type thing where they're looking at past movements of the stock price and price and or volume of the stock, volume being how often it's being traded or how many shares are being traded on a daily basis, and looking at price, how's the stock price moving up and down to predict the future. So it's all about, if we can look at a chart and look at patterns, then we can maybe predict future results based on these past patterns. So it's all about looking at patterns, looking at scenarios, situations, and very much looking to predict the future, not based on analysis per se, but more so on analyzing charts or patterns. So it's very much a trading tool. It's supposed to, let's say, long-term investing, or you're buying this company, you're investing in this company, you are an owner of the company, is very much looking at the charts. And when the chart says buy, you buy, and when the chart says sell, you sell. So the assumptions around this, around charting and things, and we'll look at an example of one of these types of assumptions or ways that you can trade, is that the market price is the actual price as far as that all information is known. So it's thinking of it as, yes, what the stock price is selling for, all information is known, and that it's a very fair price, and thus there's no value component to it as far as something being undervalued. Is looking at that, yes, that stock price indicates that it's a fully valued stock, and that all stocks are fully valued. So if you're a value investor or contrarian investor looking for those stocks that are on sale or maybe underappreciated or undervalued, technical analysis or charting would say, forget all that. That doesn't mean anything. It's not even true. We're looking at these stocks that they're fully valued, because you have to have them be fully valued in order to have predictable stocks. If they're undervalued, well, then they can't be predictable from a charting aspect. And it's all about price movements, and the belief is that price movements in stocks are not random events. If you're a chartist or looking at charts, you're thinking movements of prices of stock and the volume of the trading of stock are predictable things that can be looked at in the past and predict in the future. So very much a trading type of tool, and very much all about looking at these charts. So you analyze charts over these various time frames, and you're looking for patterns. You're looking for trends. How strong a trend is. Maybe it's a trend going in one direction that might say sell, or let's say buy, and the trend looks good, but maybe it's not strong enough to actually make a purchase. Or it might be going down the same thing, whether to sell or whatever. And the whole thing is, how likely is that trend to continue, and will it change or move in the opposite direction? And you have things that are called support and resistance areas, where it's supported at the bottom and maybe resisted at the top. So you have this band of stock prices as they go, and they might get to the top and have resistance, or the bottom, and they'll come bouncing back up off a bottom. And you're using the chart to kind of predict all this. So if you're interested in things like charting and that kind of stuff, learn more about it. I mean, we're touching the real basics on, give you an introduction to it, but it takes a lot of information, a lot more training behind it than you'd have in a course. In this course, you'd want to have a specific course around technical analysis, charting, and read up on it, and really get comfortable with that and understand. I would say that's more trading versus, let's say, investing. But it's a tool that people use. So let's take a look at one of the example charts so you get a feel for what this kind of looks like. So when somebody does a technical analysis, they'll look at the stock chart, look at a kind of graphically how it looks. And at the top, you can kind of see the price movements, it's for low prices and then moving up to high prices. And this particular example, you can see they're kind of bouncing up and down as far as the stock price. And at the bottom is the volume, how much is being traded, and all that through the same period of time. So you look at a period of time, comparing stock price and volume, and you're looking for patterns to make decisions whether to buy or sell. This happens to be called an ascending triangle or a continuation triangle. A chartist would call it that. And you can see how it's kind of got this triangle, in this ascending type phase looking at the stock price. You see how it's reaching bottoms and then ascending up. So from that, you can predict, when am I going to be ascending up again, and when will I have this base of support along this bottom of this triangle? And when I get to the bottom of the triangle, maybe that's when I'm buying, because I'm going to go back up and then keep selling and trading all throughout within that triangle. So you can see where it's ascending. Obviously, there'd be one that would be called a descending triangle, where it'd be something that's going down and maybe you don't want to buy or you want to sell. So from a chart aspect, that's all you're looking at. You're not looking at price to earnings ratios. You're not looking at dividends. You're not looking at undervalued stocks. You're not looking at growth at a reasonable price. You're not looking at the industry or the sector or the business. You're not looking at large cap or small cap per se. You're looking at charts, and you're becoming an expert at looking at graphs and charts. Hey, it's great. A lot of people do it. If you want to do it, find out more. That would be my only advice to you. I'm not a big chartist. I will look at charts and things to help support some of the things that I do in a very basic kind of way, and look at how the prices are, especially if they're nearing like 52-week lows as far as prices, looking for undervalued stocks or comparing to the industry. But I'm not a strict chartist who would say, forget all that, just look at the chart. So if it's interesting to you, find out more. That would be my big advice for you on charting and technical analysis. Understand what it is and what it isn't, and find out more. And think about more of it as a trading tool and something that's going to be, going to take a lot more investment of your time and energy and expertise, and really develop that. And maybe it's for you, maybe it isn't. It hasn't really been for me, and I've been successful well without it. But for others, they might love charting. So if you're interested, find out more. But that's charting and technical analysis. Over the years, there's been a lot of different popular styles, theories, and charts and patterns and all sorts of stuff looking at stocks and buying and selling stocks. I mean, we have the broad categories of like growth investing and value investing and income investing in these different sectors or different market capitalizations, and looking at large cap, small cap, whether by individual stocks or mutual funds. So there's a lot of different ways to invest. From fundamental analysis, looking at this company and its value and its stock prices and all that, to charting, where you don't forget about all that and just look at charts. So a lot of different ways to look at it, and from that have come out different types of theories or ideas or postulated different things that you can do. You can take advantage of and make it kind of real simple. If I just follow this program, I'll be successful. And that's the idea behind some of these kinds of programs. And one of the most famous ones out there is called Dogs of the Dow. What a great name, right? Dogs of the Dow. So you might have heard of it. It's very popular. If you look back data stuff, they've had some success and some not success, but they've had some success. It's all a matter of, well, will they have future success? It's always the million-dollar question, of course, in investing. What's the future? And you can't always rely on the past, because they say past events do not necessarily lead to future results. Our past success doesn't lead to future success. So Dogs of the Dow. Let's talk a little bit about Dogs of the Dow. So first off, who are these dogs? And what is the Dow? Well, the Dow is the Dow Jones industrial companies from way back when this was established. And basically it was a way to take the 30, not necessarily the largest, but 30 representative U.S. stocks, United States, this is for the United States then, this would be U.S.-based stocks. The Dow is 30 U.S.-based stocks that represent the entire economy. was the idea behind it. This goes all the way back to the early industrial age. So you'd have like railroads and Ma Bell or AT&T as a telecommunications first phone company, or General Electric because they made lights and electricity, and mining companies and all the different things that you'd have in there. And you had these 30 companies. Nowadays you have 30 companies, some representing newer technology, as far as the internet and computers and all sorts of stuff in there. But it's still 30 companies that are supposed to represent the broad U.S. economy, from people who make soap to people who make computers, is within these 30 companies. Well, you can probably already see that's not really super representative. That's why you see things like a total stock market index or Fortune or S&P 500 indexes to give you a broad range. But this is the Dow. The Dow Jones Industrial Averages is these 30 companies. So what are the dogs of the Dow? And how does this whole process work? Well, the dogs are the companies that are underperforming of those 30 companies. Which are the underperforming ones? And the idea is you buy every year, it's on a yearly basis, you buy those dogs in the hope that they will be better the following year, the year that you buy them. And then every year you're buying new dogs and you're selling your previous dogs. So every year you're buying and selling. And so what you're looking at is, when you look at this, is you're looking at the dividend yield, right? So with something with a high dividend yield. And why is that? Well, remember, dividend yield is the yield. It's basically the percentage that you're going to make on these dividends, like an interest rate might be a way to think of it in comparison. So if I take my dividend price and my stock price and look at those, a higher dividend yield would mean my stock price has come down and my dividends maybe stay the same or gone up a little bit. So I'm going to have a bigger percentage number. I'm going to have a higher dividend yield when stock prices come down. So if you look at the dogs of these 30 companies, these are companies that maybe their stock has not gone up as fast as the other 30, or maybe they've come down, maybe they've come way down, and you're looking at those 30 bottom dwelling companies. And the idea is you buy those bottom dwellers because you're trying to buy undervalued stocks, though they're great companies. These are 30 large major companies, so they're not small cap, fly by the night companies. These are the major players that everybody would recognize their name. And the idea is that at the end of the year, those stock prices would rise, and then when the next year comes, you look at the bottom 10 again, and you buy those same 10 again, and then you do that over and over, and you outperform the overall market by following this technique is the idea behind dogs of the Dow. And if you have, let's say, a stock that's 2 years in a row, a dog, well, you hang on to it. It's still a dog. You don't sell it until it's out of that bottom 10. So each year you rebalance and you select a new 10. Is the idea behind it. So you got kind of portfolio rebalancing right there. Now you do have some churning. You're buying and selling a lot, so you're incurring those expenses of buying and selling transaction costs. So do be aware of that. But the idea behind it is, hey, if we follow this method, then we don't even have to think about investing. We just buy the bottom 10 of these 30 companies based on dividend yield, and then we'll have success. And they've had success, and something to maybe check out. I would look at a broader range of stocks, because once again, you're narrowed to large. Only 30 stocks is your universe to choose from, versus international and just a tremendous amount of stocks in large, mid, or small cap and all these stocks. But it's a technique you can use to look at. But I would look at the broader one. But if you're interested in dogs of the Dow, go do some more research on it. But that's the idea behind a lot of these kind of programs. Like, if you follow the program, you'll be successful. And all of those can be a little bit dubious, but they got some back success with dogs of the Dow. Another popular methodology that's out there, especially right now that's popular, is called dividend aristocrats. We're looking at dividend aristocrats. And we'll talk about how do you become a dividend aristocrat, and we'll compare the results here in just a second. But the idea is you're looking at dividend paying stocks only, and you're looking at companies that are in the S&P for dividend aristocrats. They're looking at the S&P 500, so that's the United States, a large 500 company, the largest 500 companies, ones that are paying dividends, so it has to be a dividend payer of that S&P 500. And you're looking at those dividend companies, and you're selecting from that the best of the best in terms of dividends. So you're not looking international, you're not looking small cap, you're really kind of narrowing your focus on large cap dividend companies. And so the criteria for selecting companies that become part of the dividend aristocrats and build a portfolio, let's say, of just dividend aristocrats, is you're looking at companies that have paid or excuse me, companies that have increased their dividend for 25 straight years at least. Well, they would have paid for 25 straight years if they're increasing every year. So both paid, but the main thing is that they're increasing their dividend. Not only are they paying a dividend and at least maintaining the dividend year after year, even during tough times, but they're actually increasing it every year over the last 25 years, even during tough times like the Great Recession, 2009. They would be increasing their dividend. So really what you're finding here is kind of the best of the best. That's why they're called aristocrats, looking at dividend paying stocks. So dividend aristocrats, historically, if you look back at the numbers, they can be very strong in rising markets because they're getting that dividend. They're consistent dividend payers. They're growing their dividends, and I like that. I like dividend stocks, so that's a really good thing. And they're actually really strong and extra safe in falling markets because when things are going bad and the whole market's going down, well, people might do what's called a flight to safety. One, they might just pull all their money out and put it in cash or under the mattress or, go buy something for themselves, a shirt or a car or whatever it might be. But they're going to pull their money out. And when they pull their money out of, let's say, growth stocks or stocks that are really falling fast, well, where's it going to go? Well, sometimes it goes into cash or bonds, but sometimes it goes into safer stocks like dividend stocks. And so the best of the best dividend stocks in terms of paying out a dividend for 25 straight years and raising that dividend for 25 straight years is a good safe stock. It's still a stock, still volatile, but better than, let's say, like a high-performing growth stock that could go up but go down fast. So let's look at some numbers and see how these dividend aristocrats have done compared to the wider market. So this first chart here looks at these dividend aristocrats, the best of the best, the 25 straight years of paying and increasing their dividend from that large universe of Standard & Poor's large 500 company stocks in the United States. You can see how they compare to the wider universe of the S&P 500, which has a mixture of growth stocks, dividend stocks, a variety of stocks, but they're still the largest companies, the 500 largest companies in terms of market capitalization in the United States. And you can see this graph here that it's kind of followed, the aristocrats and the overall S&P 500 really kind of followed along together. If you're looking, let's say, from 2006 on to 2000, the 2008-2009 period. And then that's when you start really seeing a separation and the aristocrats doing better than the overall S&P 500. Remember, this is not every dividend stock in the S&P 500. It's just the aristocrats, the ones that paid for 25 straight years. So these ones have outperformed all the other dividend stocks and those growth and other types of stocks in the wider universe over a recent period, or at least during this time period. Here you can see it a little bit more numerically, and you can kind of see how the aristocrats did up until, let's say, 2007, 2008, 2009. You can see when we had the Great Recession and everything dropped real fast. The aristocrats dropped 21%. It was pretty bad for them too, but the overall market was down 37%. So once again, those established, raising their dividend in tough time companies did better than the overall S&P 500. And then as you look, going to the right there over time, you can see how they've been performing either near or above the S&P 500 as you saw in the previous chart. So the idea is, hey, if you just buy companies that meet this aristocrat criteria, you're going to do great. And it's a safer investment and better. It's still a stock, so it's got more risk than, let's say, other types of investments like cash or whatever. But you're doing better than, let's say, if you picked out stocks that were not these dividend aristocrats. So it makes it very easy, right? You just figure out who's got the 25 years, or you can buy mutual fund or exchange traded funds around dividend aristocrats. You just buy those stocks and then you're set to go. Look, you'll always at least outperform the S&P 500. The challenge with it, though, it might sound like a good strategy, right? But the challenge behind it is that whole past performance doesn't necessarily predict future results. I mean, you can see in the past, where the aristocrats kind of, and in many years would follow along. 2007, the aristocrats did worse. They lost money compared to, let's say, the wider market, as an example. But they've had a nice run recently, of course. Now, what happens when when dividend stocks fall out of favor? If interest rates, for example, were to rise, particularly if they were to rise suddenly or quickly, dividend stocks will tend, based on past history, to go down. Once again, people are looking for that income to come in. Will buy a higher paying bond maybe, or pay higher if it was really high on a CD or on a cash type investment versus buying a riskier stock where the stock could go up and down in price, or they could cut the dividend, cutting their income, versus something where you're locking into it more like a cash or bond type of investment where you could get that interest rate and really lock that in more securely than with any kind of stock. If that was to happen, then the dividend aristocrats would be the worst thing you could do, right? So be aware of what's happening in the broader market, particularly around interest rates when it comes to dividends and in the broader market. But here's a strategy that says, hey, if you like big companies, you like safe big companies, you like dividends and people who grow dividends, and I'm a big believer in dividend growth companies, by the way, that consistently raise their dividend, I think is really good. It compounds over time, so it's got some great advantages for you. But here they're saying you just follow this method and it'll be all A-okay. You don't even have to think too hard, just follow the method. And I've always been cautious when everybody says, follow the method, follow the program, because if you look back in history, there's times when, yeah, a program works great, but then all of a sudden it doesn't work great, and it could be really bad for a period of time, and are you willing to stick it out through the bad times, and maybe it never comes back? So right now, dividend aristocrats look great, at least during this time period. You can decide whether that's something that maybe is going to continue in the future, but it's one thing to look at. But for a personal note, companies that are, if you're interested in dividend companies that consistently pay a dividend, they got a good payout ratio, dividend payout ratio, and they've been doing it for many years, those are always good companies to look at. I just wouldn't necessarily buy into just buy the aristocrats and you're done. I would look at it a little bit more fundamentally and look at each individual company on its own merit, or if you're looking at a mutual fund, looking at a dividend paying mutual fund or exchange traded fund on its own merit as well. Okay, I'm going to share a strategy here with you now on the DART strategy that I do not endorse. I do not endorse this at all. In fact, I'm always skeptical of any type of foolproof strategy like Dogs of the Dow or Dividend Aristocrats or other things that might be out there, at least over long periods of time. Though some of their ideas are maybe good, like Dividend Aristocrats looking at good paying dividend stocks, have been paying and raising their dividends for a long time, and Dividend Aristocrats, 25 years. That's good. That's okay. I understand that. But to just say buy this portfolio of stocks based on one criteria or limited criteria, I can be a little more skeptical of it. And one reason I can be of this with a little skeptical is the whole darts theory. And it really is a theory out there. It's a darts theory where you have a dartboard and you put up like a listing of all the stocks in a stock exchange and you throw darts, and whatever your dart hits, you buy that company. You're not aiming at anything, you're just throwing it at this dartboard. And you might be thinking like, well, that's kind of dumb. And it is. It's totally dumb. But the funny thing, a lot of times throwing darts at a dartboard outperforms some of these experts and folks saying this is how you go about it, picking stocks or people picking stocks. Because things change in the market. They can be unpredictable in the market. There's no long-term planning behind it, or you're following this kind of a limited methodology. Or maybe for individual investors, it might be like, I have a gut feeling about this company, or I used to work there, I know they'll be good, all that kind of stuff that maybe doesn't turn out the way you expect. So the reason I bring up the DART thing is in my local newspaper, a newspaper from way back when. It was an old article they used to have way back when. Actually, I think they got it from the Wall Street Journal. But they had this competition in the paper where they would ask readers of the paper, they would get like 5 or 6 readers who would submit one stock that they said, this is a great stock pick I have. I'm picking this stock in this contest. And they would have, by each reader picking one, I think it was maybe 10, you'd have 10 readers, so you'd have 10 different stocks that would be the reader's portfolio, right? So this is what they're investing in. They say this is what's going to do good over I think it was like a 3-month time period. So it was not a long time period, but 3 months. So here's 10 stocks that readers picked, that each of these individual readers, they picked their best choice. And then they were competing against another portfolio, and that portfolio was picked solely by somebody at the newspaper throwing darts at a dartboard and picking stocks solely off the dartboard. And so you'd have 10 picks from readers who are reading the Wall Street Journal and reading this column and following and maybe have learned a lot of stuff and all sorts of stuff. They're picking their 10 best versus their best one to make up a total of 10 versus these randomly thrown darts, the 10 stocks and randomly thrown darts. And the funny thing is, in most of the periods, not every, but more than most periods, I'd say it was 75%, I think it got that high, of the time the darts won. The darts won. How can that be? Well, a lot of people are investing without a lot of knowledge. Hopefully, now you're going to invest with a lot more knowledge with hopefully taking this course is my goal, my idea for you. But there's people picking stocks for a variety of reasons that maybe aren't very reasonable. But the darts were consistently beating the readers. Just like when you read things like how index funds will consistently beat the high-paid, high-buck active managers of mutual funds, that index funds beat them. Well, that's why, because it's about long-term, it's about consistent investing, and it's not necessarily trying to pick that hot stock. So just threw the darts thing in here just kind of for fun. Even Dogs of the Dow and Aristocrats at least have more of a methodology. So don't do the darts thing, but it's kind of interesting that even with all this great advice out there, a lot of times the darts will win. So it might not be based on your expertise or anything. It might be just something happening in the market. The best thing that you can do is educate yourself and then make wise choices and then make adjustments as you go along the way, and then letting that compounding interest work over a long period of time. That's how you can kind of beat the darts or beat the randomness of the stock market.